Good morning, everybody. My name is Dr. G.V.S.R.N.S.A.Sastry, Head Department of Commerce and Management, K.B.N College, Vijayawada. Now we are going to discuss income from house property in income tax. Under this chapter, we discuss the following topics. One is basis of charge. Next one is exempted incomes from house property. Next, types of various rents. Next one is deemed owner. Next, determination of annual value, deductions under section 24. Now we go for the basis of charge. So the incomes which we tax under this head must have the following basis. That is, there should be a building and a land apportionment thereto. There should be a building, and if there is any connected land is connected to the building, that is also come under house property. Vacant land cannot be come under this head. That will be put to tax in the income from other sources. SSC must be the owner of the property. So, if any person get a house for rent, and if such person gave the part of their house to the another, that is what we call subletting. So, the person who get the house is not the owner of the building. So, that's why that is also put to tax under the head income from other sources. If SSC is the owner of the house property, that will come under this head. It should not be used for its own business or profession. So, the house which possessed by SSC should not be used for its own business or profession. If it is used, the expenses which connected to such property will be the allowable expenses under the head profits and gains from business or profession. So that's why the basis of charge for house property is there should be building and land apportionment thereto. SSC must be the owner of the property, and it should not be used for its own business or profession. Next one, types of rents. So the determination of house property, income from house property is around the annual value. While computing annual value, one must know the various types of rents. One is municipal rental value, fair rental value, and actual rental value, standard rental value. First one is municipal rental value. Municipal rental value means the value which is fixed by the municipal authorities. That is called municipal rental value. Fair rental value means rent of similar house in similar locality. Actual rental value means actual rent received from the tenant. Standard rental value means standard rent which fixed under the Rent Control Act. So, next, for computation of annual value, we divide the house properties into different categories. One is self-occupied property. Second one is let out property. Next one is partly let out and partly self-occupied. Part of the year let out and part of the year self-occupied, and the house is not in rental condition. So, we can discuss how to compute the annual value of different houses is as follows. First one is self-occupied property. So, as per Income Tax Act, self-occupied property, net annual value is to be taken as nil. Suppose second one is let out house property. Suppose if house property is let out, we can ascertain the annual value under three stages. One is municipal rental value and fair rental value, both are considered. Higher will be taken into consideration. Then it is compared with the standard rent. So out of these two, least is to be taken into consideration. That is what we call the expected rental value. So next, it is compared with the actual rental value, which means the actual rent received. If there is any unrealized rent, that is to be deducted. So then after deducting unrealized rent, the actual rent will be compared with the expected rental value. Whichever is high will be taken. During the previous year, if house is vacant in a certain period, so we can claim vacancy period rent also. That is to be deducted from the above value. Then it comes gross annual value. From gross annual value, we deduct municipal taxes paid by the owner on cash basis. Next, municipal taxes paid by tenant will not be allowed. Municipal taxes on accrual basis, which means if it is outstanding, that should not be claimed. Next, partly let out and partly self-occupied. Suppose if house is some part is used for residential purpose, some part is given for let out. Suppose for example in first figure 40% let out, 60% self-occupied. Second figure 50% let out and 50% self-occupied. Next in third figure 25% let out for residence, 25% let out for business, 25% self-occupied for residence, 25% self-occupied for business. Under these conditions, we assume the house consists of different units. Next one is part of the year let out and part of the year self-occupied, which means in a house we used 6 months and we give 6 months let. In second figure, we used 5 months for self-occupation and 7 months is let out. So this is called part of the year. So year consists of 12 months. In some part is used by SSE and some part is for let out. So assume that the entire house is let out. There is no benefit for self-occupation. Next one is house is not in rental condition. In such a case, the annual value of the house is taken as nil. So after getting the net annual value, we can claim deductions under section 24. So for that we divide the house properties into two categories. One is let out and self-occupied. So first deduction is standard deduction, that is allowed only for let out house property because that house property possesses NAV. So this is based on NAV. So 30% of NAV is allowed. Whereas in case of self-occupied, it is nil. So in case of interest on loan, I think we can get the loan for two reasons. One is for repairs, second one is acquisition, construction and renovation. Suppose in case of repairs, there is no limit for let out property, whereas in case of self-occupied, 30,000 per annum is allowed, including 1/5 of PCI. PCI means pre-construction interest. That will be discussed in the next point. Next, for acquisition, construction and renovation. So Again we divide it into two categories. If loan taken before 1491, if loan taken after 1491. If loan taken 1491 for acquisition, construction and renovation, there is no limit for let out property, whereas in case of self-occupied property, it is allowed 30,000 per annum, including 1/5 of pre-construction interest. Suppose if loan taken after 1491 for acquisition, construction and renovation of the house property, there is no limit for let out property, whereas in case of self-occupied property, 2 lakhs will be allowed, including 1/5 of PCA. So pre-construction interest is to be allowed in 5 equal installments after completion of the house property. How to compute pre-construction interest? So pre-construction period means from date of borrowing to the date of repayment of loan, or 31st March prior to the date of construction completed, which comes earlier. So by this we calculate the pre-construction interest. Next one is exempted gross deemed incomes from house property. Deemed incomes from house property. One is under section 10 of the Income Tax Act 1961, following incomes, just one minute. Following income from house property are exempted from tax. These are exempted from tax. One is, so the title heading is wrong, I think. These are the exempted incomes from tax. One is agricultural house property. Income from such house property which is situated on or in the immediate vicinity. Vicinity means nearby, attached to, of agricultural land which is used for agricultural purposes by the cultivator is exempted. House property held for charitable purposes. Any income from house property held for charitable or religious purposes, that is also exempted from tax. For example, rent from shops owned by a temple. Next, self-occupied vacant house. In case an assessee keeps one of his own houses reserved for self-occupation, but it is vacant because of his living in rented house due to employment or profession, that is also exempted from tax. Next one. Next one, house used for own business or profession, it is also exempted. Property held by registered trade union, that is also exempted. Income from house property held by local authority, scientific research institution, political party, or a university or a hospital which is meant for service motive, which means not earning the profits, not meant for earning the profits, shall be exempted. Next one is one of the house property owned by former ruler of Indian states, which means ex-rulers having any palaces, one palace is exempted from tax. One self-occupied house. In case assessee owns one residential house property, the net annual value of the same shall be taken as nil. If assessee owns more than one house property, according to the choice, 2 houses are treated as self-occupied and the other house or houses are treated as deemed to be let out. So this is new provision. Actually, earlier to the previous assessment year, only one house is considered as self-occupied, and the other house or houses are treated as deemed to be let out. But whereas in case of from the assessment year, it was changed. Two are according to the option of SSC, two are considered as nil. The others are to be treated as deemed to be let out. So thank you one and all.